So without any further ado, I'd like to introduce one of South Africa's very own colleague of ours here at Snail Attorneys, in a sense, because we've done some work in conjunction with each other before. Myself personally also having had to share a platform where we needed to speak to issues surrounding cryptocurrency. And if you ask me, Nerushka Bowan is one of the people who are actually very knowledgeable on the subject. So just a quick test before I introduce you. Nerushka, is your audio on? I can see your slides.
It's on. Hi.
Okay. Hello. I'll try to be brief. Nerushka is an emerging technology law specialist, legal technology innovator, as well as an international speaker. She is founder of the LITT Institute. If I'm not mistaken, that does stand for Law, Innovation, Technology Tomorrow. So I'm, without wasting any time, just going to mention that she was listed on the cryptocoin.news as one of 20 African women to watch in blockchain and crypto. So Nerushka, over to you.
Thank you so much for that introduction. And I just wanted to also just add, Melody, I was fascinated by your presentation, covered many topics that I often debate with myself. So it was really nice to see all of those legal areas covered in your presentation. Also, thank you to the earlier crypto speaker. I think he really covered a lot of background for cryptocurrency and blockchain. So now I don't have to do it and I can jump straight into the regulatory aspects. So my topic is cryptocurrency regulation in South Africa. And I'm literally in these minutes that we have today, going to give you a high-level overview of what the position is right now with regards to crypto regulation, and also just some information of, for anybody who wants to read deeper, where you can look to find that information. So, just to start, I mean, often a lot of talks when we come to cryptocurrency, Bitcoin, blockchain, there's often a kind of philosophical component and a bit of an ethical component built into it. So just to introduce that at the start, I'd like everybody to think about their relationship with money and what money means to them. We all actually have money in some way or the other. You may have some notes in your wallet right now. And of course, I'm assuming everybody on this call has access to banking and has money stored away in a bank somewhere. Have you ever thought about that money, and the form of that money? So for example, do you think the bank is keeping notes for you somewhere in a vault? And every time you go to the ATM, they're dispensing from your little wallet? Of course not. A lot of our money today is actually digital. It's actually a contract between you and the bank, and a promise between you and the bank that the money that you electronically deposit in the bank will pay you back that money. And if we all try to withdraw our money at the same time from the bank, we'll actually collapse the banking system, because all of that money doesn't actually exist. There's obviously more you can read into how financial systems work and things like that. But in essence, a lot of it is based on promises, contracts, and fiction rather than real life money. So that's just one thing with regards to money that people don't often think about, and just something to get you start questioning things and looking at the world a little differently. The other thing I like people to start thinking about is to make the distinction between what is man-made and what is kind of natural and what's made by nature. And often things that are man-made are capable of being changed. We often think we take those things for granted and we believe that they can't be changed. So for example, things like borders are man-made. However, rivers, mountains, forests were all natural type of attributes that we have on this earth. But the border between two countries is a man-made border, and they have changed over time. Similarly, things like laws, things like money, the concept of money, all of these things are man-made concepts that has changed over time and will continue to change as our society develops and as our technology develops. And I think that's what we're currently going through, is this change this transition period, and we don't know yet what the future looks like and what our relationship with money will be. However, the concept of digital money is nothing foreign. 92% of the world's currency is already digital. So we're already living in a digital world, a digital economy, digital money. These are not new concepts, but perhaps just the way we interact with money and the way we receive our money may change in the future. And a lot of the proponents and how cryptocurrency actually came about initially was on the back of the world economic crisis, where people kind of lost that trust in government, in a sense, and created trust in technology and mathematics instead of governments. And we've already seen, more and more people start trusting technology over governments over this time. And now we're starting to see governments interact with these new digital currencies and also try to regulate these currencies. So it's quite interesting because these currencies were actually started to be separate from the ambit of government and almost exist outside the scope of government. But now we're in a world where regulators are now trying to regulate these very things, because they also acknowledge the long-term consequences of widespread adoption of these various digital currencies that we have. That's just a bit of the philosophical side and of discussion today. And now I'm going to jump straight into the regulatory position in South Africa and give you a little overview of what's happening. So to give you a bit of a roadmap, in about 2014, we had a position paper. National Treasury and SARB had released this position paper with regards to virtual currencies, and it discussed on a variety of types of electronic money, and it was quite useful for a number of years because we didn't have anything else to really look at when it came to digital currencies. And the position paper basically said, these things are not regulated and, use at your own risk. So it was not illegal, but, if you did play in these unregulated markets and you got burned, you can't really come to the regulators for help after that. So it was more of a consumer protection warning than anything else in that position paper with regards to cryptocurrencies. But it also touched on other forms of electronic money. So it's still relevant in respect to some other forms of electronic money. And it is quite an interesting paper for anybody who's interested to go and have a look. Then in 2016, there was something called the IFWG that was created, and this is the Intergovernmental FinTech Working Group. And since then, the IFWG has had consultations and workshops with industry and stakeholders, and through that has drafted various papers and requests for comment about policy positions and regulations when it comes to crypto specifically. But the IFWG obviously governs a wider ambit of fintech rather than just cryptocurrency. So then in 2018, there was a subgroup of the IFWG created called the Crypto Assets Working Group, the CAWG. And it's really under the umbrella of the Crypto Assets Working Group that we've now received some updated consultation papers and position papers. The first one was published in 2019 and was called a consultation paper. It was put out for comment. And then after receipt of those comments, updated position paper was finally released earlier this year in 2020. And that updated position paper basically takes over the position of virtual currencies as it was written in the 2014 position paper. And the 2020 updated position paper is really a detailed document from a policy perspective. It really gives a lot of recommendations with regards to the regulation of cryptocurrencies. And of course, the word used by the regulators, and this has changed over time, because in 2014, it was called it was called DCVCs, decentralized virtual currencies. It changed to cryptocurrencies, and then now finally the word or the terminology is actually crypto assets that the regulators use in their papers. So I'm going to do a high-level overview of what's actually in the 2020 position papers, so you can have an idea of what they are trying to regulate. So just also to give a little bit more background as to what the IF of the IFWG, I think it's .co.za, and you can go and read all the really interesting things that they're doing from a fintech innovation perspective. So there's basically three main arms. The first one is the Regulatory Guidance Unit, and the Regulatory Guidance Unit actually assists in giving non-binding guidance from the regulators on various fintech related queries. So you can actually go to the Innovation Hub and request regulatory guidance directly from them. Of course, they call it non-binding guidance, but it does help you, especially if you're playing in a gray regulatory area, it does help you get a little bit of direction when it comes to regulatory questions. The second arm of this is the regulatory sandbox, and this is quite an exciting one. Regulatory sandboxes have been used by financial regulators in a number of jurisdictions to kind of navigate this regulatory gray area where you have a lot in the fintech space, and the existing regulations don't fit what the new players are doing quite well. You then initiate something called a regulatory sandbox, where you invite these innovators to come and collaborate with the regulator. And during that period, they're allowed to test their new products, their new services, and test the regulatory boundaries without fear of consequences from the regulators. So, in turn, the regulator gets market research and a kind of understanding of how these technologies work, and also an understanding of what potential developments are required in regulation by seeing how these participants do in the regulatory sandbox. There's quite a nice FAQ sheet that they published not too long ago, setting out all the commonly asked questions when it comes to regulatory sandbox, because it is something very new and innovative from a regulator, and people have a lot of questions about it. The third arm is something called the Innovation Accelerator. And this is actually an environment for the regulators themselves to explore and innovate. And it's, quite an exciting thing to think of regulators innovating. There's a whole arm called RegTech, which is regulatory technology, and SupTech, which is supervisory technology. So they're really looking at how they can implement that into their own businesses to become innovative regulators, which is quite exciting. One project that they did do about 2 years ago was something called Project Coca, and that is where they used a blockchain to do, they did a trial run, a pilot of using a blockchain to do end-of-day settlements between all the large banks and the South African Reserve Bank. It was a successful pilot. However, they have made it quite clear that there's no intention to ever replace the settlement system with a blockchain. However, they have proven that it is possible in theory, and done quite a comprehensive report, the Project Coca report, if anybody's interested in reading more about that. So these are the regulators who are part of the IFWG, Competition Commission, the FIC, the FSCA, even the credit regulator, National Treasury, SARS, the South African Reserve Bank, of course. So, it really is a combination of a variety of regulators. It started off with 4 of the financial regulators, and they have since, encompassed some of the other regulators as well. So this is the definition of why they actually created this innovation hub and why the IFWG was created in the first place. So this is the explanation behind it. Innovation has always been driven the financial services sector forward, but the South African and global services landscape is currently evolving at an unprecedented scale and pace, driven by a number of trends in the market. Fintechs and other new participants are becoming increasingly prominent characters that are providing core financial products and services like payments, loans, and insurance. They are no longer fringe players and won't wait for regulation to catch up. Oftentimes, new participants don't fully understand the regulatory framework or what is needed to comply. Regulators need to reckon with these new types of market participants and new products and services and move side by side with them to understand the impact of innovation, to tackle the new challenges posed by this changing landscape, and to capitalize on the emerging opportunities it presents. Regulators recognize the need to respond in a manner that is proactive, coordinated, and collaborative, and subsequently designed and implemented the Innovation Hub and its offerings. So it really was a reaction to the variety of innovations happening in the FinTech Center. So I'm going to jump now to the position paper that was released by the Crypto Assets Regulatory Working Group as a result of the various workshops and consultations that they had with stakeholders. So this is the definition that they've given of crypto assets. A crypto asset is a digital representation of value that is not issued by a central bank, but is traded, transferred, and stored electronically by natural and legal persons for the purposes of payment, investments, and other forms of utility, and applies cryptographic techniques in the underlying technology. So they're moving away from the word currency. They don't want crypto to be viewed as a traditional currency because it does have a variety of other hats that it wears. It could be like a security, it could be like a bond, depending on how it is structured. So the word crypto assets is the preferred term. Here are some of the use cases of crypto assets and things that people are doing with it. Well, you can buy and sell a variety of crypto assets on a variety of exchanges and platforms. You can use crypto assets to pay for goods and services. You can launch new companies through something called an initial coin offering, which is a way of getting funding for your new venture and your new crypto asset that you may be creating. There's also markets now developing in terms of funds and derivatives and various market support services that are now becoming established as the market becomes more mature. These are some of the risks that the report, that the position paper also identifies. Of course, there's always a risk of crypto assets being used for purposes of money laundering and terror financing. This has always been a big regulatory risk that all the regulators have looked at. Potentially people evading things like ex-con and paying taxes by using crypto assets. Potentially cybersecurity issues, because we've had a lot of crypto asset exchanges being hacked and large numbers of crypto assets such as Bitcoin and various other coins being stolen through these hacks. The creation of potentially parallel unregulated markets. So if you know anything about the darknet, there's an entire market on the darknet run completely in parallel using things like crypto assets like Bitcoin and more privacy type coins to buy and sell a host of things, including fake IDs and passports, drugs, guns, and more sinister and dark things. Other risks are the lack of consumer protection. People have seen other people become very rich very quickly through buying and selling of crypto assets, and kind of got caught up in the hype, and in the process got caught up in a lot of scams. And therefore, there was a very, very important need to introduce consumer protection into this market. And then a lot of people buying into ICOs. You know, it's very different buying and selling shares on the JSE, where those are blue listed companies that have been vetted and comply with a whole host of regulations. ICOs can be just about anybody deciding to launch something new and selling their kind of shares or coins, and you may get nothing in return for those ICOs, but the people who launched the ICOs often make a lot of money. Or there was a period in 2018 where they made very, very large amounts of money. Crypto assets are notorious for being volatile, and the price shoots up and shoots down in short spaces of time. And of course, there's no globally defined legal framework as to how to deal with crypto assets. So of course, that is a risk. The position paper sets out the number of recommendations. I'll just go through some of them. The most important one, of course, crypto assets are not recognized as legal tender. They are not electronic money. So they do have some other type of form or asset class, and they should not be allowed for payment settlement. So the SAMOS system will not be replaced by crypto assets and should not be integrated into existing financial infrastructure in the absence of a regulatory framework. So existing incumbent players in the financial services system should actually wait for a regulatory framework before integrating crypto assets into the infrastructure. So this would be your existing banks and things like that. They are recommending for regulation first before services. Buying and selling should be included in the definition in the Financial Services Regulation Act and the upcoming COFI bill. The COFI bill is the Conduct of Financial Institutions bill, and they should be licensed by the FSCA. The ICOs should be deemed securities in terms of the FMA and the upcoming Conduct of Financial Institutions bill. SARB should monitor illegitimate cross-border flows, and crypto assets should fall within an individual single discretionary allowance for cross-border payments. They also introduced a term called crypto asset service providers. And these are really the intermediaries, the service providers in the ecosystem who are providing a variety of services. These could be trading platforms, vending machines, wallets, token issuers, funds or derivatives service providers, and your custodial wallets. Custodial wallets should be accountable institutions and licensed in terms of the COFI bill. Crypto asset service providers, again, also accountable institutions in terms of FICA, and they must comply with the FATF recommendations, which were published a little while ago as well. Collective investment schemes should not allow crypto assets, and for pension funds, they've left the decision up to the FSCA. And mining, which is a process used in the creation of Bitcoin and the verification of transactions, there are no regulations released by the financial regulators with regards to mining. SARS released a media release or a press release in April 2018 on the treatment of cryptocurrencies when it comes to tax. And they basically said the same rules apply. So if you're making an income, you declare it as your income. If it's a capital gain, you declare it as a capital gain. And how do you determine if it's an income or a capital gain? Well, you look at our existing case law to make a determination. So if you bought it 5 years ago and you just held on to it and you sold it this year, it's more likely to be a capital gain. If you're buying and selling every second day and you're like an active trader, it's more likely to be income tax related. Also, at present, VAT does not apply to crypto assets. In July, there were FICA draft amendments released, and these FICA amendments basically align to the FATF recommendations, and the recommendations state that crypto asset service providers should be included in the definition of accountable institution, which means they will have to comply with FICA, which means things like conducting KYC checks on their customers and the reporting of suspicious transactions. A few days ago, the FSCA, Financial Services Conduct Authority, made something called a draft declaration. This is still out for comment, and it's open for comment until the 28th of January 2021. Some of the recommendations for regulations in terms of the draft declaration is that crypto assets should be included in the definition of financial products in terms of the phase. And crypto intermediaries providing advice or services must be licensed as financial services providers and comply with all the phase requirements. Existing businesses once this declaration becomes final, must submit the application within 4 months of the declaration becoming active. And any new business for crypto assets, you cannot start your business until you receive your license from the FSCA. So this is quite a game-changing declaration once it comes into effect, but the industry actually is welcoming this level of regulation because they believe it gives them, a little bit of legitimacy rather than being seen as this dark parallel market. There are a variety of consortiums and groups in the country that are promoting blockchain and cryptocurrency in various ways. There's a South African Financial Blockchain Consortium, which is all the financial institutions working together to see the impact of blockchain in financial services sector. More recently, there's the development of the South African National Blockchain Alliance, funded by the Department of Science and Technology and run out of the CSIR. Really, this is looking to position South Africa as a leader when it comes to cryptocurrency and blockchain on the continent. Anybody can become a member by going to the website and connecting as a member and staying in touch and seeing what the latest news is in the sandbar world. So I think I've reached the end of my time. That's it for crypto regulation in South Africa, literally just a high level of what's going on, the latest when it comes to cryptocurrency and the latest position papers and what might be coming up next when it comes to cryptocurrency. Thank you.
Thank you very much, Nerushka, for an extremely informative presentation. I see there's a comment here from Vilimili. The ongoing discussion is extremely informative, Nerushka. Do you find that there's a solution provided by smart contracts to cyber attacks on crypto assets? That's a question from Vilimili.
So I think the attack on crypto assets is not really an attack on the asset itself. I think when it comes to the cryptography embedded in the technology, whether it's Bitcoin or whichever other cryptocurrency or crypto asset you're looking at, oftentimes the crypto asset themselves is quite secure. Where the vulnerabilities exist is in the intermediaries, and the intermediaries being your custodial wallets or your exchanges where these are traded. And oftentimes it's due to things called hot wallets, where wallets are left connected, live on the internet, and then your cyber criminals, obviously very smart, find ways to slowly siphon off these coins from these wallets over a period of time until they actually detected. So that's where we find our cybersecurity vulnerabilities. And I'm not sure if smart contracts alone can be the solution for that, but perhaps there is something to look at there. But oftentimes the crypto assets themselves are quite secure. Thanks.
Here's another comment from Melody Musoni. Rich and detailed presentation. Thank you, Nerushka.
You're welcome.
So if there's any other question, yes, Philemila says he's answered. Is there any other question from the floor? We are almost at the last presentation, and then we're going to do the recap for the day. Or would you like to keep those questions for later? Okay, I have one question, Nerushka. Yep. Where can I use my crypto assets? Is there like a website that tells me where I can buy using crypto assets? Like a
So a lot of the payment intermediaries, existing payment intermediaries like PayFast, things like that are slowly adopting crypto payments as one option of payment. So when you're doing a checkout, they'll ask you Visa, EFT, PayFast, PayPal, whatever. It's usually one of those payment providers who would have payment by crypto as an option. So your usual shopping, whether it's Take-A-Lot or wherever you do your online shopping, you could have those options quite easily accessible to spend it, and it's becoming more accessible as time goes on. With regards to kind of going into a physical store and making a payment in crypto, it would be as easy as making a payment with a SnapScan. just showing a QR code, getting a code scanned, and making your payment directly from your wallet. Retailers have trialed this already, and there have been pilots done. But as far as I know, beyond maybe a few coffee shops and bars that are around that do accept directly crypto, there's not widespread adoption. Maybe there have been recent developments, but as far as I know, there's not widespread adoption, but there are scattered places where you can physically go and scan your QR code. In terms of how many people are doing it, it's still a small section of people who are actually, regularly buying and paying for things in cryptocurrency. I think it's also people who are earning in crypto who tend to do that. So you do get people, especially who are working on a global market, who get paid in cryptocurrencies, because it's actually a lot easier to make global payments with crypto rather than traditional methods. And it's often those people who then find ways of using their crypto and spending it, because that's how they're earning it, instead of converting it back into fiat currency. And I think as time goes on, those opportunities will increase rather than decrease, especially with they becoming more regulated and more legitimate, rather than being seen as this thing that happens on the darknet. Thank you.
Thank you, Nerushka. Wait, I think there's something more. You're lucky. In your personal view, was the regulator's choice correct in selecting the term crypto assets, as it speaks to the view that Bitcoin or Ethereum are closer to digital cash than digital gold, despite what the original inventors originally intended? That is a comment from Gerard Pillay. Thank you.
I think, the benefit of having the word asset compared to currency is that it encompasses a lot more, because crypto assets can be different things. It could be a security, it could be a bond, it could be a utility token. And if it was limited to the word currency, we would see it in a very linear way. We'd say, okay, currency, you use it to buy and sell, and we would be fixed in that box. Whereas the word asset, we say, okay, asset can be X, it can be Y, it can be Z, and then it opens us to really understanding it can be doing a lot more. So I'm actually comfortable with the term crypto asset.
Okay, looks like Gerard is also quite happy. Fantastic presentation. Thank you for your answer. So yeah, I think we've abused you enough, Nerushka. Thank you very much for once again being the guru on crypto assets. It's always lovely to hear from you. One presentation of yours is never like the other, so that's one thing I really like about you. Okay, let me go over to the next presenter. Now, the next presenter is Dr. Annette Petrova. Let me just see where she is. Dr. Petrova, are you there?